Okay, what's going on, everyone? This is going to be the PowerPoint video for chapter 12. What are we looking at here? Right? Investments. And specifically, we're looking when we have one corporation, right? Maybe it's Walmart or something like that, and they purchase the stock of a second corporation, right? So maybe Walmart buys Amazon's stock. It's obviously going to go on their balance sheet. And in this chapter, we're going to see how do we account for that. And specifically, we'll be looking at equity securities and debt securities. So when we talk about financial instruments, right, there's really two types, equity and debt. From the investor's point of view, right, with equity securities, right, this would be like buying stock of another company. And really what we hope to do with either of these is to make money, right? If we have stock, you would get dividends. You would also hope to have appreciation on the stock, and you're actually an owner of the business, right? Like I own 15% of that company. Where in distinction with debt securities, bonds, and notes, right, when you buy them as an investment, it's really just a lending agreement, right? I will lend you the money, you'll pay me some interest, you'll pay me some interest, I'll get my principal back. How I make money through there would be through interest income. So we're going to really look at how do we account for this. We'll start with debt securities, then we'll go to equity securities. So debt securities, right, they specify when the item matures, the principal that's to be paid, and the interest that's to be paid, right? A very common example is a bond, right? Look, I'll give you 10 grand today. You pay me some interest, pay me some interest, pay me some interest, and I get my 10 grand back, right? That's kind of the setup with a bond. When we account for a bond, right, whatever we pay for that is what we pay for it. But in terms of the actual accounting, we take those items from the issuer's perspective and we shrink down that future payment, 10 grand. We shrink down all of the annuity payments, and that will tell us what the bond will sell for. And it essentially do one of three things. It'll sell at par, where the market rate equals the stated rate. It'll sell at a discount, or it will sell at a premium, right? We'll look at those kind of scenarios here. But in this situation, right, we have a $700,000 bond. 12% is the stated rate. So S is stated. You can just think money in the sense the stated rate tells us how much cash money is going to be paid. Interest payable is 42 semi-annual. So anytime there's semi or quarterly, that typically is a hint that you might need to convert, right, the I and the N. It matures in 3 years. And hey, we, company one, are buying this bond today when the open rate on the market is 14%, the market rate. This tells us what our interest revenue is. So when we shrink that bond down, right, the $700,000 bond, essentially in today's dollars, that's 666. That's what we pay for it. And in this way, right, the stated rate of 12 is less than the market rate of 14. So we're going to be looking at a discount. In other words, we pay less than face. If it was greater than the market rate, you would be issued at a premium. Okay? That's what this slide is kind of saying. Now, when we talk about a bond, right, when we purchase it as an investment, we're going to say, hey, what's the journal entry when you buy it? What's the periodic journal entry whenever we get the cash interest payments and we record kind of the interest revenue for it? How do we deal with reporting the bond on the balance sheet? Part of it depends on how we classify it. Is it held to maturity, available for sale or trading? And then what do we do and how do we account for it when we sell it? Kind of universally, regardless of the classifications, right? Because we have held to maturity, we'll have available for sale, and then we'll have trading security under debt, right? For all of these, at least the purchase in the kind of revenue portion of it for the interest revenue will be the same, right? So we buy it here. In this case, it will be debit bonds for $700,000. We paid $666. We'll credit the discount on there, right? That's when you buy it. Now, right, 6 months has passed. We have to accrue for the fact that we're going to get our first interest payment, and that we're also going to have to deal with getting rid of that discount in recording interest revenue. In this way, right, what we will do, right, for the interest received, right, the cash interest received, we'll base that off the stated rate, and it's semi-annual, so we'll have to convert divided by 2. And for the interest revenue, we will base it off the market rate, because it's semi-annual, we'll have to divide by 2. Calculate those items. You can plug them in down here, and to the extent there is a difference between the interest received and the interest revenue, that is how we're going to start to wipe out that discount. Right, so it's basically a little schedule there. Another way of looking at this, and this can be from the issuer's perspective, but we would grab these numbers as the investor to use just like a simple example, right? It would be 700 is the face. The discount is 34. So the carrying value would be 666. We'll multiply that, right? The equation's up there, times the market interest rate per period, right? So in this item, right, it's 14% divided by 2 gives us 7%. That'll give us our interest expense of 46. We'll back out, right? So that was based on the market rate. Then we'll back out the cash payment per period based on the stated rate, right? So this is face times, what was that stated rate over there? Let's see here. I think it was 12%. Yeah, 12% divided by 2. That will be 42. 46 minus 42 is 4. That's the amortization. Then next period you would add that down. You'd be at 670. You'd run the math. If this thing helps you to just kind of plug it in here, you can do that. If this schedule helps you, you can do that. So that's kind of the universal entry for buying it as time passes, kind of that periodic entry. Now we're going to have to look at how do we deal with reporting it on the balance sheet, right? Whenever we have held to maturity securities, we're going to use amortized cost. Whereas whenever we have available for sale or trading debt securities, it's going to be fair value. All of this kind of begs the question, what do we mean by this? In other words, how we deal with classifying it and putting it on the balance sheet and accounting for it, a lot of times comes down to intent, right? Held to maturity, right? These guys, I don't know, maybe I'll make orange. This is like a Charizard, right? Charizard's that color. Maybe I have that Pokemon card. Theoretically, I love my Charizard. I'm going to keep it the rest of my life, right? If we have a bond as a way of an analogy there, we plan on theoretically keeping this bond throughout the rest of the term. Now, something could come up. Maybe we go bankrupt. Maybe we're in a situation where we need to sell it, but we really don't plan on selling it. We're going to hold it to maturity. In distinction, right, on the flip side, maybe you have trading securities. That's yellow like a Pikachu. Maybe I have like 50 Pikachus. I'm actively trying to sell this thing. And when I buy this bond, I plan on selling it in the near term. It's not something that I'm going to hold until the rest of the term. So that, if our intent was to actively sell this bond, then it would be classified as a trading security. Finally, right, available for sale, that's kind of blue for like a Blastoise Pokemon. It's like a really good card, but it's not my favorite ever. I'm not really trying to sell this, but if somebody gave me an offer I couldn't refuse, then I would be open to the possibility of selling it. It's available for sale, right? So depending on how we classify the bonds, that will deal with the treatment, right? So held to maturity, unrealized gains or losses, right? So the bond is here, it goes up in value, it goes down. As a general rule, we're not going to recognize them, and we're going to put it on the balance sheet at amortized costs, right? That's just kind of this guy over here from running the schedule. In distinction, available for sale and trading securities that are debt securities, we're going to put on the balance sheet at fair value. In other words, we will consider the change if the bond's gone up or not down in value. But where the change goes depends on how we classify it. In other words, trading securities, you put in net income, whereas available for sale securities, you're going to put in OCI when you have those unrealized gains or losses. When it's ultimately realized, we'll flip it into net income, but right now we're talking about unrealized gains or losses, holding gains or losses. So let's look kind of starting with this. The first one is held to maturity, right? This is like the Charizard. We buy this bond. We planned on holding it for the next 10 years, right? It's an investment to us. So the fact set, right, that we used before, it was like a $700 or $700,000 bond. We bought it for, I think, like $666. And then they tell us at the end of the period it's worth $714. How do you deal with this fact that, it's 700, but now it's worth $714 when it's held to maturity? Basically nothing, right? In other words, like, you're not going to account for it on the actual income statement, but you will do a footnote, right? So generally you'll ignore for at least the actual financial statements, but you might disclose it in a footnote. One thing to be aware of with held to maturity investments is, like, yes, while we plan on holding them to maturity, it doesn't always happen that way, right? There may be an instance where, due to an unforeseen circumstance, we have to sell it. Now, how would we account for that? Right, so we got that $700,000 bond. Looks like due to unforeseen circumstances, we had to sell it, right, for $725. So you do debit cash for $725. You then take it off the books, right? You kind of undo the amortized costs where it's at. So flip out both accounts, and to the extent there's a gain or loss, you're going to plug. In this case, you'll plug the gain. You can read that about impairment. Yes, it's possible that there would be impairment on those. I'm more concerned about the basics with it. So when we talk about held to maturity debt instruments, right, realized gains or losses, in other words, whenever we sell in that kind of unforeseen circumstance where we have to sell it, that's in net income. Unrealized, kind of the holdings, ebbs and flows, are a footnote. Don't touch OCI. When we put it on the balance sheet, right, amortized cost are kind of the magic words there. And then for purposes of the statement of cash flows, when you buy it or sell it, the actual bond, you're looking at the investing section for actually buying it and selling it. And then if you receive interest payments, typically the interest payments are going to be in the operating section. Okay, so you can look at that kind of example there. So that's like one of three, right? That's the held to maturity, the Charizard. We plan on holding that till the end. Now we're looking at kind of the Pikachu, right? The trading security. I buy this bond, but I'm really planning on selling it in the near term. In this case, right, we're going to account for it on the balance sheet at fair value, and those unrealized gains and losses are going to go on the income statement. Right, so let's look at this example, right? Remember, at the end of the period, it's at 714, right? We were carrying it at amortized cost of 671, right? So it was at 671. Now it's worth the fair value of 714. It's gone up by 43,000. So at the end of the period, right, we'll tee up the fair value adjustment and then recognize the gain as part of net income, right? That's great. Then it says, oh, okay, by the way, we want to sell these bonds, right? Because it was a trading security. So say we sell it for 725, right? So it went from 671 to 714 to now on the date of sale, it's at 725. So what we need to do, right, it went up another 10. So we're going to repeat that journal entry, except with a 10, right, because we need to get it where it is on the date of sale on fair value, right? We'll then put it in net income, right? So it's kind of like when you sell a fixed asset, you get the depreciation up to the date of sale, then you dispose of it. Here you get the fair value up to the date of sale. It's already in net income, teed up fair value, teed up fair value. Then we get rid of fair value, get rid of the bond, and debit the cash that we got. There is no gain or loss here when we actually sell it. Instead, we recognized that gain or loss as the ebbs and flows of the fair value happened. Okay? You can look at that item there. So when we talk about trading securities, right, income statement, basically, like I said, the changes in value are going to go in net income, not OCI. Balance sheet, we're talking about fair value on there. And whenever we buy and sell trading securities, debt securities, that is going to go in the operating activity section of the statement of cash flow. So this one is different, right? Operating when you buy or sell. The other two, held to maturity and AFS, are in the investing section. So I'm just going to put a little star there. That's different. Okay, so you can look at that guy. And then the third here is available for sale debt security. So this is kind of like our Blastoise. We don't really want to sell it, but if somebody comes along and gives us a good offer, we're open to the possibility of it. Our intent is a little bit unclear here. So again, we're going to put it on the balance sheet at fair value. We're going to track those changes in fair value, but this time they're part of OCI, not net income. So we kind of put it in OCI as a holding tank for the unrealized gains or losses. Then when we sell it, we take it out of that holding tank and we put it in net income. Right, so same kind of setup here, right? We bought it, we recorded it at what, 671 at the end of the period. It's now worth 714. It's an available for sale security. That's our intent, how we classified it. It went up by 43. So we tee up the fair value adjustment. The unrealized gain is going to go in OCI. That's great. We then sell it later on, right? So it went up a little bit. That's great. We did that. And then it went up again by an additional 10, right? And then we sold it on that date when it went up. In this case, first thing, again, we got to get it up to where it needs to be. That's going to go in OCI. That's great. So we built up the fair value adjustment twice. Then we get rid of the fair value adjustment. That's great. This time, though, right, we built it up into OCI. 1, 2. We're going to take it out of OCI and then put it into net income on there. So when you sell it, yes, an available for sale on sale goes on the income statement. But when it's in, that is to say, when it's a realized gain or loss, it goes in net income. But when it's unrealized, it's in OCI, right? So the cash and then get rid of it on there. You can look at impairment for there, not that big of a deal, more concerned with the basics. So again, the income statement, unrealized gains and losses are in OCI. Reclassify out of OCI and into net income whenever it's realized or you sell it. Balance sheet, we're talking about fair value. And cash flow statement, this is going to be the investing section whenever you buy it, right? Interest is generally going to be in the operating section. So you can see some examples here, the difference between held to maturity, trading, and available for sale. Amortized costs, fair value, fair value. Unrealized gains, not applicable, goes to net income, goes to OCI. That's kind of the basics with it. There is a possibility for a fair value option, right, where you can essentially elect to treat held to maturity or available for sale securities under this fair value option it functionally makes it like trading securities, right? In other words, you'll use fair value with unrealized gains or losses to the income statement. You can look at this. That's kind of the basics there for debt securities. Now let's move to equity securities, right? We'll look at how do you deal when you buy it? How do you deal when you receive dividends? How do you deal with those unrealized gains or losses? And then how do you deal when you sell the investment? When we talk about equity securities, right, it's not necessarily our intent that matters, right? It really comes down to what portion or what ability do we have to influence the corporation that we invested in, right? So generally, if we don't have significant influence, right? Let's just say like I'm a 1% owner of Apple. I can't tell them what to do, right? I'm just like a 1% owner. In other words, if it's less than 20% you own, we will use this fair value through net income method. It'll be very similar to the trading securities approach. So 0 to 20%. If we own between 20 to 50%, right, then we will use, and assuming we have significant influence, we will use something called the equity method, right? The equity method basically has our pro rata share of the investee income on our income statement, which will increase that account. Dividends don't affect net income, but instead will reduce that investment account. So we'll talk about that. And then finally here, if you own more than 50%, i.e. you control it, you would consolidate the books and records. In other words, their balance sheet and income statement will merge with our balance sheet and income statement. Very complex, very hard stuff that it's beyond the scope of this class, but I'll just say IFR 2 or 3, right? You do consolidations in later classes, but for us, it really comes down to, it's not a hard and fast ownership percentage. That's kind of a ballpark. It's more like, do you have significant influence? Do you have control, or do you not have significant influence? That tells us how to account for it. Let's start with when we do not have significant influence, right? Maybe we bought some stock on July 1st. They then gave us a dividend on December 31st. The stock changed in value as of the end of the year from when we purchased it, and then we sell it. How do we account for this, right? Maybe we own 5% of the company, right? Something small, right? We lack significant investment. So when you buy it, right, you'll do debit investment, credit cash. That's great. Whenever it pays the dividend, right, you'll do credit dividend revenue, debit cash. This should be very similar to what you've seen in financial accounting. Here's kind of the new thing, right? We bought it at that amount, right, 1.5, but at the end of the year, it is 1.45. So in other words, it's gone down in value by 50. In this case, very similar to the trading securities for debt instruments. In other words, that change in fair value, because that's how we're going to report it, fair value through net income, is essentially going to be put on there, and then that loss will essentially be accounted for with the fair value adjustment. It then says, hey, okay, right, there we are, we got the fair value on it, and then it looks like on January 5th, the beginning of next year, we sold it, right? How do we deal with this? Well, in this situation, right, it looks like it went from what, 1,450 to 1,446. Oh no, it went down in value again, right? So it went down and then it went down. Kind of a similar thing here, right? We have to, again, take the loss, to get it up to where it needs to be, right? So we accounted for it there for the fair value change here. That was the first one. And then we got to do it again for the second drop in value. Then once it's up to date, right, it's on our books for where it's supposed to be, then we can do the journal entry for the sale. All right, we sell it, debit cash. We get rid of that fair value adjustment, right? We teed it up once, teed it up twice. Now we can get rid of it and get rid of the investment on there. The gain or loss, right, we don't recognize on the actual sale because, again, we did that throughout as we tracked the fair value. They then give an alternative item here. It said if they didn't sell it, you can look at that. But when we talk about equity securities, specifically when it's the fair value through net income, i.e. we own less than 20%, on the balance sheet it's going to be current or non-current. Statement of cash flows, operating or investing, depends on your intent there, or kind of your company's policy. But that was the first one, fair value through net income. Very similar to what you would have seen in accounting, in kind of like your intro accounting class. But the only change there is we have to track the fair value changes in net income. The next one here is the equity method, right? We own somewhere between 20 to 50%, and we have significant influence, right? If I own 25% of Apple, I can kind of tell them what to do, or at least my voice will be heard because I own a reasonable amount of their overall stock. In this case, right, I always think of equity method kind of like pro rata. We're going to put it on our balance sheet, the investment, right? So when we buy it, right, we're essentially going to do the 1.5 that we paid, credit cash. We're a 30% owner. That's great. Now, what happens is during the year, the company we invested in made some income. We're a 30% owner, so we're going to record 30% of that income. And when we do so, we will increase our investment and equity account. So we start with it. The company made money. So it's kind of like, here we go. We started with it. They made money. It goes up. They lose money. It goes down. They made money. It goes up. Tracks it pro rata based on our amount. When we receive a dividend, right? So we were here. It looks like, it went up because it made money. And then when they declare a dividend, it goes down, right? So we got the cash for the dividend and we reduce the investment. Dividend is not dividend revenue whenever you're dealing with the equity method of accounting, okay? So you can look at those. You can look at the impairment on there, and then if you change between methods, how that works. And then here it's, what if you sell it, right? Well, essentially in this situation, it says the balance at the date of sale was 1.54. So right, we had it, we're tracking it. Oh, we sell it at that point in time. It's 1.54. We get it off the books. Here's what we sold it for. The difference is a loss, right? So we have fair value through net income, less than 20%, right? It's going to basically be what we looked at on there. Then we have the equity method, 20 to 50% was the second item. So you can look through those kind of journal entries and compare how you would account for that. The fair value option, again, kind of available there. You can read that. The last few items, right, talk a little bit about a financial instrument, right? It's defined as one of the following: cash, evidence of ownership, interest in an entity, a contract you can read through there. Essentially with it, right, when we have financial instruments, it's kind of like a stock or bond. That's one thing. It's a contract, among other items, that gives right to a financial asset for one entity and a financial liability or equity instrument for another. One kind of example that we haven't talked about is a derivative. You'll learn about that if you take finance classes, but the idea with the derivative is that it derives its value from something else. So for example, a stock option, right? A stock option gives the holder the right, but not the obligation to purchase the stock in the future at a price set today, right? So for example, if I gave you a stock option, you could buy the stock at $50, and then later on the stock is selling for $60. right? In that situation, the option is worth 10 bucks because you could exercise the option and then sell it and make $10. In other words, the value of that option derives from and is connected to something else, the value of the stock. Other kind of investments, right? So we've talked about debt investments, we've talked about equity investments. There are other kind of investments on there, special purpose funds. So these are amounts we set aside by companies to be used for specific purposes. So like, hey, we're building a building, right? We need to set money aside for that. Hey, we're setting money aside to pay back a bond that we issue. Essentially, whatever it's connected with, that's how you're going to classify it. Finally here, talk a little bit about life insurance policies. Corporations can buy these, right? Like imagine, for example, your Tesla and Elon Musk is at the helm of it, right? If something bad happens to Elon Musk and he dies, we're going to lose a lot of value in our stock because a lot of our wealth is connected to him being in charge of everything. So to protect ourselves from that situation, we as the corporation, kind of Tesla Corporation, would buy a life insurance policy on Elon Musk, right? Where we, the corporation, would be the beneficiary. Essentially what happens here when we buy this life insurance policy, every month or 6 months, right? There's some kind of periodic, we'll just say every month we have to pay a premium, right? So maybe we pay $1,000 a month or $1 million a month, whatever it is, right? Whenever we pay this premium, right, some of this goes into the kind of like underlying, if he passes away, the payout from the policy, right? When he dies, they'll pay out 10 million, 20 million, $1 billion. And some of this actually goes into sort of a fixed investment known as the cash surrender value, right? So you could always, for example, surrender this policy and get this money out from it. It basically represents the amount the policyholder receives if they cancel the policy before death or maturity. Why we care about this is when we make the monthly payment or the periodic payment, we have to figure out how much of this is going towards the life insurance policy versus how much of this is going towards the fixed investment and account for it accordingly. Right, so we have an example here. Several years ago, they acquired a $1 million insurance policy on its CEO. They pay $18,000 in premiums. The cash surrender value at the beginning of the year, right, was 5, and at the end of the year, it was 7, right? So in other words, it went up by 2 during the year, right? So whenever we make the payment of 18, right, 2 of that was for the cash surrender value, and the remaining 16 was for kind of the payout portion of the policy. They then said the cash surrender value is considered a non-current investment that would be reported in the investment section. When the insured officer dies, right, like Elon Musk dies, they receive the death benefit and the cash surrender value ceases to exist because the payout happened. Right, so say that the CEO died. At that point in time, we get the $1 million of cash. We get rid of the cash surrender value. And the difference there will be a gain on the life insurance policy. So that's kind of it. Like I said, you can look through. I'm not concerned about credit losses and impairment necessarily for the exam. I want to just get the fundamentals to you about investments. So I'm trying to keep this kind of chapter short and to the point. What is relevant? What do you need to know? With that, I'm going to end it here, and we will see you in the next video.